Hey everyone, the Walt Disney Company reported third quarter fiscal year 2023 earnings results that had a lot for investors to digest. So in this video, I will review the figures, break them down, and I will also update my recommendation on Disney stock. Coming into this report, I had Disney stock rated as one of my top stocks to buy right now. So you're going to want to tune in to see if I'm changing that recommendation. So let's get started. Revenue increased by 4% to 22.3 billion. Operating income was flat year over year at 3.55 billion, but Disney's been restructuring the business and taking a lot of non-cash write-downs for the business. And if you look at its cash flow from operations, that jumped by 46% to 2.8 billion, which more accurately reflects the rebound in the business after economies started reopening and lockdowns have subsided in major economies in the world like China, like the US. And so the company's benefiting from that, and people are unleashing that pent up demand, going out away from home, traveling, taking cruises, staying at hotels, going to Disney's theme parks, and that's been benefiting the company. Disney's park segment, which I just talked about, revenue increased by 13% to 8.3 billion, and operating income increased by 11% to 2.4 billion. Typically, you'll see Disney's operating income jump much larger than its revenue would jump. But again, the company took some non-cash expenses here as it closed down one segment of its theme park business in Florida. And so it took a write down from that closure. And again, another example of Disney just taking these write downs right now while it's available to it and lowering its earnings right now, and then it'll benefit from that because it'll have these write downs, these tax losses that it can capitalize on when it returns to earnings growth next year. So linear network, this is the part of Disney's business that's extremely troubled. It's the cable channels. Revenue fell by 7% to 6.7 billion, and operating income fell by 23% to 1.9 billion. This was a combination of two things here. Number one, people are canceling their cable subscriptions and moving to streaming instead. It's just a lot more convenient for folks. And then on top of that, marketers are spending less money on advertising in those linear segments. So they're moving their ad dollars elsewhere also. So that's the 1-2 punch that's hitting Disney's linear network business. And this business has continued to fall, and I suspect it will continue to fall. But at some point, it will, I feel, stabilize and losses will reach an equilibrium. Some estimates suggest that will happen at about 50 million cable subscribers. Just to give you an insight, it's right around over 70 million right now. So there's a lot more downside to go before this side of Disney's business bottoms out and stabilizes. Disney announced it is raising prices again in its streaming segment, and the striking workers could lower content budget by 3 billion to 27 billion in the current fiscal year. That's down a lot, right? Before this, Disney lowered that content budget from 33 billion down to 30 billion, and now it's estimating another 3 billion, so 6 billion dollars of less spending on content for Disney, and that's going to be positive in terms of its cash flow from operations because it's spending less on content. But at the same time, many of its competitors are also spending less on content because they too are impacted by these worker strikes. So this happened before during the pandemic when content budgets were slashed because of lockdowns. Studios were not able to make as much content because, bringing people together wasn't really feasible during the earlier stages of the pandemic. And that was also a big benefit to the industry's profitability and cash flow because when everybody was not spending on content, there was no competitive advantage for anyone. And so it just boosted profit margins industry wide. And it'll be curious to see if the same impact happens here as a result of this strike, and it also remains to be seen how long this strike will last. I also wanted to show you this decline in terms of the linear network and the offset to direct to consumer, which is its streaming segment, right? So I noted earlier that linear network revenue, the cable business, is declining, 7% decline. But the direct to consumer business is gaining, right? 9% increase from 5 billion to 5.5 billion. So with Disney launching its robust streaming services, right? It has Disney Plus, it has Hulu, it has Hulu Live TV, and it has ESPN Plus. It's capturing some of the people that are canceling its cable subscription. But the thing is that the streaming business is not yet profitable while it transitions there, right? So the streaming segment lost 500 million on 5.5 billion in revenue, but that was a huge improvement from the 1 billion it lost last year on 5 billion in revenue. So it's demonstrating strong economies in scale, and management reiterated the forecast that it will be profitable at the end of 2024 as it reduces investment and revenue grows, followed by price increases as well. And here I have Disney's total subscribers here, streaming subscribers, and you can see a big loss here from Disney Plus Hotstar subscribers, falling from 52.9 million down to 40.4 million. But I also wanted to show that these subscribers are not as meaningful for Disney, because Disney Plus Hotstar average revenue per user is only 59 cents. 59 cents. So despite the fact that they lost 13 million, nearly 13 million of these subscribers, at just 59 cents, it's not a big deal for Disney. What's more important is its domestic and international subscribers, which generate $7.30 and $6 respectively in terms of average revenue per user per month. So these are much more meaningful subscribers. And in this segment, Disney overall had a gain here from 104.9 million to 105.7 million. So in this more important part of its streaming segment, it gained subscribers, right? I also wanted to note that it does have a live TV streaming option, right? So for those folks who still want that cable bundle, but they want to get it over streaming instead, Hulu Live TV offers that, right? And Hulu generates a strong average revenue per user of nearly $92 per month for that subscription. So, and Disney has over 4.3 million people subscribed to that. So hopefully, as people cancel their cable subscription, if they still want that cable bundle, they can go to Hulu Live TV and get that cable subscription, and Disney will still capture revenue from those users. So to update my recommendation of Disney stock, I still rate Disney stock as one of my top stocks to buy. It is going through the transition which you are seeing in its business from the cable to the streaming segment. But overall, longer term, I see that as an opportunity, because what it means for me is going from cable to streaming, people are going to consume more content, right? Because if you have it streaming, you can have it on your phone, your tablet, your iPad, your laptop, and you can take it with you wherever you go. You're going to watch more content. You're going to watch more content, and overall, that's good news for a company like Disney that's in the business of making content. Now, the transition will be messy. It'll be messy going from this business model to the other business model, but longer term, people are going to be watching more content, and that's good news for a company like Disney. But that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.